this short video, we will discuss purchasing power parity. We will first define the economic concept and then move on to discuss other concepts similar to purchasing power parity. We will conclude the video with discussing purchasing power parity and how it is viewed within the currency markets. Purchasing power parity is defined as the amount of capital needed to purchase the same amount of goods and services in two different countries. Using purchasing power parity, an amount of money has the same ability to purchase goods and services in different countries. Among other uses, purchasing power parity rate facilitates international comparisons of income, salaries, and growth. The concept was first developed in its current form by Gustav Cassel in 1918. The idea is based on the law of one price, where in the absence of transactions costs or transportation costs or official trade barriers, identical goods will have the same price in different markets when prices are expressed in the same currency. So, in theory, $1 worth of US dollars and what it can buy is equivalent to $1 worth of yen and what it can buy at the same time. The purchasing power parity theory states that an exchange rate between one currency and another currency is at equilibrium when their domestic purchasing powers at that rate of exchange are equivalent. The law of one price is a concept that states that identical goods must have the same price within efficient market theory. For example, within the financial markets, given complete transparency, a trader will purchase a fungible commodity at the best offer and will not pay a higher price. Although purchasing power parity and the law of one price seem the same, there is a difference. The law of one price applies to individual commodities, whereas purchasing power parity applies to the general price level and a basket of goods. If the law of one price is true for all commodities, then purchasing power parity is also true. Deviations from equilibrium imply differences in purchasing power parity of goods and services across countries, which means that for the purpose of many international comparisons, countries' GDP, their gross domestic product, and any other national income statistics need to be adjusted and converted into its common units. The best known adjustment is the US dollar. The real exchange rate is equal to the nominal exchange rate adjusted for differences in price levels. If purchasing power parity is held exactly, then the real exchange rate would always equal 1. In practice, though, real exchange rates can fluctuate and be volatile in both the short run and the long run and show relative deviations. The exchange rate reflects transaction values as well as interest rate differential, speculation, hedging, as well as other interventions from central banks. Other type of indexes that have been used historically are the Starbucks Tall Latte Index as well as the Big Mac Index. This concept gives investors and traders information about a current relative value of a particular product that is purchased across countries throughout the world. Given a specific rate, an analyst can make a determination of whether a currency is over or undervalued on a purchasing power basis. Purchasing power parity, in theory, should tell an investor the value of a currency pair. A currency pair is a relative value of one currency versus another. For example, the euro versus the US dollar exchange rate is currently near 130, which means that it costs $1.30 to purchase 1 euro presently. Currency markets are volatile and fluctuate based on numerous factors. Generally, currency markets move in the direction of interest rate differentials between two currencies over a period of time rather than the purchasing power parity of those particular currencies. For the most part, for example, higher interest rates in one currency will drive investors to that currency to hold that currency and earn the higher yield rather than earning the lower yield. Although the theory of purchasing power parity could tell an investor the value of one currency relative to another, the majority of currency investors look to other factors to make determinations of relative currency direction.